Today, I have Beatrice Yeo, economist at the $6.2 trillion US trillion dollar money manager, Vanguard Australia. Beatrice is a Chartered Financial Analyst and serves on the global economics team and is responsible for contributing to Vanguard's global thought leadership through research on markets, the economy, and investment strategies. Prior to moving to Melbourne, Beatrice was based in Vanguard's Hong Kong office, where she covered a range of macro and portfolio construction research topics. Today, we'll be discussing the pandemic shock, the economic recovery, the wider implications of the pandemic, and what investors could expect in a post-COVID world. Beatrice, welcome to the show.
Thanks for having me.
The global COVID-19 pandemic has caused probably the sharpest and deepest short-term economic contraction in modern history. And even though some countries succeed in controlling the outbreak, the case numbers continue to grow globally. And the twin crisis here of health and economics are far from over. Can you put the pandemic shock into perspective, and more specifically in terms of health measures, containment measures, and the impact on economic activity?
Yeah, sure. So, typically we see that there are three approaches used to combat a health crisis, right? At the far left, we have what we call a laissez-faire approach, which is the most lax out of the three approaches. And it's essentially where, governments just let the ball run and they don't do anything, let the virus spread until around 60 to 70% of the population is infected, thereby, building what we call herd immunity within the population. So, that's one measure. And on the far right, we have what we call a suppression approach, which is the most aggressive out of the three approaches. It's what we have seen most governments to date adopt, with this COVID pandemic. And essentially, what governments do is basically mandate lockdowns and, force businesses to shut down temporarily to prevent the rapid spread of the virus. And, in the middle between laissez-faire and the suppression approach, we have what we call the mitigation approach, which, governments don't actually, force businesses to lock down and don't shut down the entire economy, but rely primarily on social distancing rules and rely on people like you and I, to voluntarily adopt social distancing measures. We saw countries like Sweden adopt it, as well as the UK initially before they found out that it didn't work as well, and they switched to the suppression approach. So I think depending on, which approach, countries adopt, there could be, a lot of discrepancies in terms of the health developments, in terms of, how well the virus is contained, as well as the damage on the broader economy. So take, for instance, say China, right? China, was really using the suppression approach. And I think it's interesting to note that even within the suppression approach, there are varying degrees of suppression, right? With China really, at the far right, taking outright suppression by shutting down the entire economy, while countries, like the US, for instance, they didn't actually take a nationwide shutdown measure, but, relied more on state governments to actually impose their suppression measures. And so we see that China, being the most aggressive of all of them, we saw that its Q1 contraction in GDP was actually one of the largest, around a minus 10% Q-on-Q drop. And in fact, our own alternative indicators that we measure, where we used to measure China's underlying growth, actually suggest that, even a sharper contraction than the official statistics. Some people also question whether, Chinese statistics can be relied upon. And so, I think that's definitely quite a severe contraction compared to, say, somewhere like Japan, which took more of a mitigation / low suppression approach, where you saw that their GDP in Q2 only contracted by about minus 7% to minus 8%. So I think, depending on, how aggressive governments are in terms of their containment measures, that's definitely positive for public health, as we have seen with the case numbers in countries like China, but can also come with very damaging economic cost.
When you talk about the different measures that different countries around the world have taken, governments have been very involved in this particular crisis, probably more so than we've ever seen.
Yeah.
It's been I think, bold. It's been quite swift. And I think what was so different about this policy response from what a typical standard economic downturn is that they were not so designed to encourage folk to go out and spend, rather to keep the economic and financial system, or the plumbing, so to speak, to continue flowing. Can you explain for us how governments achieve this? Because with the benefit of hindsight, we know how well the financial system continued to operate. Contrast that to the global financial crisis of 2008, 2009, where financial markets literally shut down. We didn't see that this time around.
Sure. So, in our view, there are actually two phases of policy responses. The first phase is usually, a relief package, really in the form of a crisis management tool used to stabilize the economy and the financial system. But then, once the outbreak is contained, and once consumers are willing to get back to the street to consume, and that's why we should be talking about, not just a relief package, but really a stimulus package to help encourage spending. But so far, I would say most of the announcements to date have really been centered within the first bucket, within the relief package more so than the stimulus package, given the unprecedented nature of this shock, with policymakers taking a whatever it takes approach to support businesses, consumers, and households. And we estimate that over March and April, where that was basically the peak of the downturn, we saw about 200 over policy initiatives announced across the globe. And I think this just goes to show you how drastic, the measures have been, not just in terms of, the magnitude of the size of stimulus, but really in terms of as you said, the swiftness and the decisiveness of the policy support. And, it's one reason why we expect the rebound in the economy to be much faster, given that, the policy support, while it doesn't provide much upside, it at least helps to cushion some of the downside risks of the economy. And, I think this gives us hope that there will not be as, much permanent scarring as we saw back during the GFC. And I think one reason why, financial markets have rebounded so quickly this time around is because, while this downturn is going to be one of the deepest global recessions in record, it's also expected to be one of the shortest recessions. Just given the nature of the shock, that's really a supply, and demand-driven shock. But as long as the supply shocks start to fade, as lockdown measures are eased, we think that the rebound in the economy should be pretty quick. So that's one. And I think one way to see how effective the policy responses have been to date would be to look at places like the labor market, for instance. We see that to date, most of the layoffs, both here in Australia as well as globally, have been more temporary in nature, which means that as social life gets back to normal and businesses resume operations, that there's hope that the unemployment rate can come off much more quickly and help accelerate the economic recovery. You contrast that to the last downturn during the GFC, where unemployment rate similarly surged to levels seen today. But the key difference then, was that a large part, around 80% of the unemployment, we think, were more structural or permanent in nature, which is a very different story that we're seeing today play out. So that's one place we could look at to give us, some hope in the outlook. And I think the other place to look at would also be, bankruptcy statistics as well as default rates. To date, on a year-to-date basis, we see that on an annualized basis, the number of bankruptcies, both in the corporate as well as in the personal side, are lower than what we saw in 2019, are lower than what we saw, during the GFC, and also lower than the level that should have been implied by the current rate of economic contraction in the economy, as well as in the labor market. And I think this, again, goes to reflect the very generous loan and grant support schemes provided to businesses, mortgage forbearances and window payment holidays provided by banks, as well as government income transfers to help offset the decline in household income.
There's a couple of things you raised which I want to spend another minute on, if that's okay. You mentioned this is the quickest, sharpest decline from a economic output perspective, so GDP, but also we saw that in the stock market too. Are we seeing swifter, sharper declines that don't last as long because of central banks' now ability or intentions or desires to get more involved in financial systems, beyond inflation, controlling inflation measures and employment, and now getting their sleeves rolled up into financial stock markets and so forth. Do you think that we could start to see economic output in stock markets that fall quicker and deeper, but rebound a lot swifter than maybe they would have been 70 years ago?
Yeah, so I think there are a couple of issues here that we should be mindful of. As you said, the pace at which the equity markets globally declined as well as picked up was actually quite striking this time around. And I think there are a couple of reasons for it. One is, as you said, the unprecedented nature of policy support, especially monetary policy, and injecting liquidity into the financial system. And while it didn't create much, inflation in consumer prices, it definitely created a lot of inflation in asset prices, particularly the equity market. And you can actually pinpoint the bottom in the equity market the day that the Fed actually announced open-ended QE. So from that angle, I think central banks definitely are becoming more and more of an important driver in supporting risk sentiment as well in equity markets. But I think the other reason that why we have seen such a quick rebound in equity markets, in fact, we estimate that peak to trough this time around, it only took less than 2 months, versus data of closer to 13 months during the GFC, as well as even longer at 2 years during the Great Depression. And I think the reason, besides policy support and besides the forward-looking nature of markets, I think the other reason to keep in mind is also the very different, again, going back to the nature of the shock, the very different nature of the shock this time around, where it's both a supply as well as demand shock. Versus back during the GFC or back during the Great Depression, which was mostly a demand-driven shock, driven by excessive leverage and excessive imbalance in the economy, such that when asset price bubbles burst, that led to a prolonged deleveraging process that took many years. But this time around, we see that the financial system globally have become much healthier with much less imbalance and less leverage. We see that in the U.S. they have largely completed their deleveraging process post GFC, and so this gives us confidence that post the initial shock, post the initial supply shock to the economy, that we won't get into that sort of prolonged balance sheet recession or prolonged deleveraging process where instead of spending, consumers are using the income that they earn to pay down their debt.
When we talk about boosting businesses and boosting households, are we boosting or are we delaying the inevitable? You hear so many references to zombie companies and companies that really shouldn't be around. And a lot of companies are now struggling, literally shut down and surviving on JobKeeper and another form of support from the government. Is this the calm before the storm? Is this going to be worse than what it is now?
Yeah, I mean, I think there's definitely a concern that, we see a fiscal cliff, right? Once the fiscal payments, fade off, that, people basically have no income to live on. But I think so far, that risk has kind of come down quite a bit, especially here in Australia, with the fiscal payments being extended to Q1 of next year. So, there's, I guess there's a hope that, by Q1 of next year, that the economy should get back up and running, even, not basically back to pre-pandemic levels, but at least in a much better shape than where we are right now with lockdowns easing, even here in Melbourne. And so there's hope that, once the payments actually expire, that people will be able to find jobs by that time. As consumers, return to the streets to consume, as businesses are able to operate again and are not forced to lock down. And I think one place we could look at that, how this will potentially play out once the fiscal stimulus fade off in Q1 next year is to look at the US. We all know that, the unemployment insurance of $600 per week expired on July 31st in the US. But, surprisingly, if we look at some of the high frequency indicators in the US, whether it's retail foot traffic, whether it's restaurant visits, that hasn't really collapsed to the same degree that you would expect to have in a, fiscal cliff scenario. And I think that's because, of the massive savings that households have actually recorded, during the crisis, where, they receive a lot of the unemployment benefits, but, the bulk of it was used saved instead of spent because they have no place to spend it on, right? And so I think in a similar case, here in Australia with the Q2 GDP release, we saw that, instead of declining household income, we actually saw household disposable income actually increased by about 6% over the quarter, despite the shocks to employment. And off that, we saw that the bulk was actually saved instead of spent. Household consumption actually fell, contributed about 6.8% to the 7% drop in GDP. So there was definitely, not much spending going on there. And instead, we saw that the savings rate, jumped from 6% to close to 20%. And we think would have been even higher if we accounted for things like the super withdrawal payments, et cetera. So I think, on the savings front, we estimate that that could potentially, help households to survive without any stimulus checks for another 2 to 3 months. And hopefully by then, we'll see the economy kind of rebound.
Yeah, it sounds a little bit like a transitionary mechanism,
Yeah.
more so than this cliff that everyone can see coming and no one's doing anything about it. That's interesting to hear those statistics coming out of the US. I've got one more question before we change gears, Beatrice. You talk about China and whether or not, you can believe some of the data that's coming out of China. If we refer to China as maybe the imperfect leading example of where the rest of the world might go here, it's understood the virus started in China, China shut down, China reopened. And from what I understand and from what I hear anecdotally is that China has reopened significantly, largely almost going back to normal with work and foot traffic and a whole bunch of things. Can you give us your opinion as to whether or not you think China is an imperfect indicator for the rest of the world when it comes to post-pandemic?
Yeah, sure. So, I think this is not a 1 or 2 day thing where, people don't trust Chinese statistics. I think, this is a structural debate that's been going on, not just within our industry, but the broader academic community. But, regardless, and that's why, we, as well as many other houses out there, we also develop our own activity tracker of the activity in China. And so even though, the official statistics, like the number itself may not be, I guess, as trustworthy as some people put it, but, I think the magnitude overall, it still provides useful guidance for the rest of the world, even the developed world, because China was basically, as you said, first in and first out of the epidemic. And so, looking at how the recovery has played out there, I think could provide some useful guidance to us. And I think on that front, we have also seen evidence of a two-speed recovery or a multi-speed recovery in the system, where, we are seeing industries such as manufacturing, construction recover much faster than, say, the highly face-to-face intensive industries like, recreation, entertainment, et cetera. And so what we did was look at high frequency indicators such as, movie ticket sales, hotel occupancy rates, and compare those with, things like steel production, coal consumption, et cetera. And what we found was that, those proxies for manufacturing, construction, like steel production, coal consumption, they were pretty much, normalized back to pre-COVID levels already, sometimes, by June or July. While, if you look at, things like movie ticket sales and hotel occupancy rates, as a reflection of the more highly face-to-face intensive service sectors, we actually see that they're still about 50 to 60% lower than the pre-pandemic levels. And they seem, the recovery seems to be, basically stalling in a more U-shaped gradual normalization process than a V-shaped rebound. So I think that's definitely some useful guidance to what we can expect here in Australia as well. But the reason why I think it's pretty interesting that you say an imperfect leading indicator is because, I think China as a whole, it's pretty different in its economic structure, right? We know that about 50% or even slightly more than 50% of China's output really comes from industrials and manufacturing, versus, that of most developed economies like Australia or the US or the UK, where most of our output actually comes from services rather than, mining or industrials. And so on that front, we think that, the highly face-to-face intensive industries will recover at a much slower pace than those heavy industrial sectors, which can largely operate under social distancing rules, or, consider essential services. And so the initial supply shock there is much lower, as well as, the eventual persistence of that negative demand shock will also be lower in those heavy industrial industries than it is, in the more highly face-to-face intensive service industries. And so from that front, we're expecting the recovery in most developed economies to be much slower than, that seen in China, where we're expecting China to largely recover or normalize back to pre-pandemic levels by the end of this year. But we think it would take more than 2 years for countries like Australia, the US to actually recover back to where we were before the crisis.
That's a really good segue, Beatrice, in referring to the opening or the recovery beginning, if you like. Financial circles, and I noticed you threw out a few letter recoveries. Financial circles have this obsession or this fantasy to attach a letter to some sort of recovery. You refer to V shape, U shape, L shape, and it's probably safe to say that the stock market has had a particular recovery, a letter-shaped recovery. The economy is showing a different shape. Now there's been thrown K-shape, which some economies are going to do well and some economies are, or some industries are not going to do so well. Can we talk specifically in Australia around your base case, pessimistic and optimistic scenarios as to how you see this recovery playing out in Australia? And if you want to attach letters to them, I'll give you permission to do so.
Yeah, the alphabet soup.
Yeah.
And in fact, it's not just, as you said, VUK, there's also the W and L shape recovery put out there as well. But, we actually don't think we have to choose one out of, the 4 or 5 letters. And instead, at Vanguard, we think that the recovery would take the form of both a V as well as a U shape. It's really a V-shaped rebound in terms of growth rates turning from negative to positive. And that's what we already saw in China in the second quarter and what we expect to see in the third quarter for most developed economies, including Australia. But we all know from our Simple Math 101 class, which, it reminds us of the old days, that, if growth declines by, say, 8% in one quarter, a rebound of 8% in the following quarter will simply not be enough to get us back to where we were in terms of the level of activity. And so it's really in that sense that we say it will be both a V-shaped rebound in terms of growth rates, but a more prolonged U-shaped normalization process in terms of returning back to pre-pandemic levels. That is to say, even as lockdowns fade and supply shocks fade, I think most people, both you and I, will voluntarily maintain social distancing measures until, a vaccine is found, until a vaccine is developed. Just think about it, right? I think that's one thing for governments to reopen their borders and for airlines to be able to operate once again as per normal. But it's another thing to say that we as consumers, we want to get on an airplane and, with 300 other people and breathe in the same air for, 5 or 7 hours. So it's really that distinction between the willingness as well as the ability to actually, resume your social life, that we think that until an effective therapeutic treatment is developed, that, the fear and uncertainty associated with COVID will continue to prevent many consumers from returning to their normal life, particularly their social life. And that will have implications for, different sectors of the economy, particularly those that are highly face-to-face intensive, as I mentioned earlier.
What do you think? We talked about GDP and unemployment. If we think longer term, what do the longer term prospects look like for economic output and for employment, maybe here in Australia, and if you want to give your point of view globally as well?
Yeah, sure. So I think, how things would play out longer term really depends on whether we actually get a vaccine, right? I think some clients have actually raised the possibility, what if we don't get a vaccine forever, right? And I think, if that actually happens, we would probably expect, certain industries to never be able to return back to where they were in terms of their output growth as well as spending. And, if that's the case, not only will we not recover back to pre-pandemic levels, but the pre-pandemic level itself may actually permanently shift lower, just as what we saw during the GFC, where we really never returned back to where we were before the GFC. And instead, the potential trend growth rate actually fell permanently downwards. So that's definitely a risk that we could see. And, I think there's a risk that, the longer this drags on, the longer, the vaccine is not developed. I think the risk is, we'll see more and more of the temporary layoffs become permanent. And I think that's what we're starting to see already, with the employment statistics, that what really started off as, mostly being temporary layoffs, that we're seeing that proportion of temporary layoffs actually start to decrease slightly over the last couple of months as, more and more of these workers actually get laid off permanently. And same with businesses as well. You might have written the headlines, Yelp and, different survey industries where, millions and millions of small businesses, they actually just shut down their doors permanently. And, that doesn't actually get captured in the statistics, given that, many of them don't actually take out a loan from a bank. And they're also, not well captured by official surveys. So I think there's definitely a risk there, especially if a vaccine is not developed. And longer term, I think, whether we're able to, sustain a higher potential growth rate, I think also depends on whether we're able to lift up productivity growth. And productivity growth, really depends on a couple of things, right? Whether you have, good or sufficient investment spending, business investment spending, as well as whether, you have things like, physical working spaces can also encourage, idea sharing, what we call the idea multiplier. And it's why we think that, without, a return back to normal life, that productivity growth may never actually pick up to where we were.
That's a really interesting point. There's a couple of things I'd like to touch on if we can. The first is with the amount of government spending that we've seen government debt levels continue to soar and continue to make new records. What does all of this mean for inflation, and what does it mean for government debt? That's the first part. I might let you answer that first, and then I'll talk a little bit about growth and company in spending and so forth. So inflation and debt. So what's your take on that?
Yeah, so given that, we're expecting the recovery of demand to lag the recovery in supply, that essentially means that you have a persistent negative output gap until, say 2022. And that will continue to exert disinflationary pressure on, prices and on inflation. And that's why we think that for most developed economies, most economies will actually undershoot their 2% inflation target for some time. But then, we always know, especially from Japan's case, that there's a risk of, keeping inflation so low for so long that inflation expectations become anchored at such a low level, and it's very hard to, get it back up, as we have seen in the case of Japan. And so that's why, we have seen policymakers like the Fed, for instance, they recently announced what we call the average inflation targeting regime, which essentially, assures market that, they're going to remain as accommodative as possible for as long as it needs to take inflation back up to an average of 2%. So instead of having the 2% target as a ceiling, they now have it as an average. And hopefully, they hope that this will help to, boost up inflation expectations. Whether that will actually work remains to be seen, because as we know from Japan's case, right, the BOJ also, promised back a couple of years ago that, they announced what they call the inflation overshooting commitment, where, they promised to stay as low as possible as needed to overshoot the 2% target. But, obviously, as we see with the statistics, no one actually really, bought into that story. And instead, what we had was a loss of credibility by the BOJ. So I think, it's probably worth watching how this plays out for the Fed. The Fed might probably have a little bit more credibility than the BOJ at this point in time, but, how much of that can actually feed into inflation expectations still remains to be seen, because we know that, the reason why inflation has undershoot 2% target for the last 2 decades is not so much due to cyclical policies being, inadequate, but it's really due to structural forces such as globalization, technology actually weighing on prices. And that's, not something that can be changed simply by, monetary policy, cyclical policies. So I think that's more on the inflation front, and I think there's more to watch on that front. And on the government debt front, I think as a precursor, it's important to note that there's no magical number by which, once a country hits that level of government debt to GDP ratio, that, growth starts to fall and interest rates start to rise. There isn't like a tipping point that's the same for every country, because I think every country, is different, right? Take for the US, for instance, you could argue that the US has the ability to sustain a much higher debt to GDP ratio, just given that it has a reserve currency. And it's also why, despite the significant rise in US government debt over the last couple of years, we've actually not seen interest rate rise, right? Because of that demand for that safe haven currency and safe haven US Treasury. So I think that's one versus somewhere like Argentina, which obviously cannot sustain, such a high level of debt compared to the US. and what we have seen, their problems as well that they're facing at the moment. But essentially, when governments start to think about paying down their debt, at this point, I would say it's not front and center in many policymakers' minds, given the nature of the shock. But once we're past the shock and governments start to think about how they want to address this issue, typically, historically, we have seen that there are three approaches being taken. One of three approaches being taken. The first is via increasing taxes and decreasing spending. And usually that takes the form of, 2/3 decrease in spending and 1/3 increase in taxes. The second way is to grow their way out of debt. So basically, as long as your nominal growth rate exceeds the interest rate on debt, you can basically chip away at your debt to GDP ratio over time. And so we estimate that for most developed economies, including Australia, as long as they maintain a nominal growth rate of about 4 to 6%, that could potentially eventually cause their debt to GDP ratio to be rather stable or even slightly decrease over the next decade or so. But if they really want to actually decrease their debt to GDP ratio, we think that they'll probably need a slightly higher nominal growth rate of 6 to 8%. That's achievable, but it's probably a little bit of a stretch given where we are at the moment. But nonetheless, it's something that policymakers can think about in terms of growing their way out of debt. And then the final approach is via inflation. Right, so inflating away their debt, and this often comes in the form of money printing or monetization of the debt. But as we've seen from the case of certain emerging markets like Argentina, this is also a very risky and not very effective measure, as obviously they have not gotten their inflation under control to date. So I think that also is probably inflating away your debt is also something that scares a lot of investors. And something that we probably don't want to see as a standalone measure. And so what we have seen historically, those countries that have successfully, decreased their debt to GDP ratio, instead of taking one out of the three measures, it's usually a combination of the three that leads to a successful, kind of chipping away at their debt over time.
We talk about inflation. We talk about pandemics. I want to go back to the 1918 influenza, and depending on which statistics you look at, the history books tell us it killed 40 million people, 50 million people. Maybe we'll never know what the answer is. At that time, it must have seemed as though going back to normal life would never be able to be resumed. Who would want to be risking their life and contracting a disease that would kill them just to go and, have a drink at a pub with a friend? What we saw though, post 1917, 18 and 1919 flu pandemic, we saw a really quick, it was almost sort of manic flight to socializing, which then took us into the roaring 20s, where economic growth was really strong, inflation, and what happened then, you touched on it earlier about too much leverage, too much speculation, and we saw that in the late 20s, which then subsequently led to the collapse of 1929 and the depression that followed. Do you think that what we're going through today could potentially follow a similar path, that of 1918, 1919? Or sorry, more so in the subsequent roaring 20s?
Yeah, sure. So I think before we go into whether we'll, get into the same path as the roaring 20s, I think it's worth, kind of looking at from the health aspect, how this virus is, how it compares to the 1918 Spanish flu. And, there are several ways to compare the relative severity of epidemics or pandemics. One way is to look at the mortality rate or the fatality rate, and the other way is to look at the contagion rate, or what we call the R0, which is basically a mathematical term used to assess how contagious a virus is. And from that angle, if we just look at this COVID virus alone, it can certainly feel a little overwhelming, right? The fact that we're seeing, more than 28 million cases recorded worldwide, and more than 900,000 deaths recorded so far. It feels a little overwhelming, but it's actually not unprecedented, really in terms of the number of cases and the number of deaths, where, if we look back at the 1918, as you said, there were more than 500 million cases recorded globally, and more than 15 million deaths recorded, which certainly makes what we're experiencing today pretty minor and pretty small. But I think what's unique about the current pandemic is that, while its fertility rate isn't as high, we estimate as a fertility rate of around 2 to 3%, compared to 10% experienced during 1918, or even 30% experienced during MERS, the MERS in Saudi Arabia and that region. But it's actually this virus is actually much more contagious than historical pandemic, where the R naught is essentially, scientific research put the R naught at around 2 to 3, which means that for every person infected with COVID, they can basically go on and infect 2 to 3 other people, compared to, the low ones. R naught for SARS, for instance, was around, 1.3, 1.4, and the R naught for, Spanish flu was slightly higher, about 1.8. But none of them were as contagious as what we saw with the COVID virus. And I think why it hasn't spread as badly, despite being so contagious compared to the Spanish flu, is because of the magnitude and as well as the severity of the lockdowns we have seen this time around, compared to the Spanish flu, where back then they basically took too few measures, and took it too late as well. So I think that's why we saw the rapid spread of the virus. Now, whether this opens the door for extreme lockdown fatigue, where people just get so sick of being stuck at home that they basically just go out and go crazy once the lockdowns are eased. To a certain extent, I think we are already seeing this sort of pent-up demand play out today. Right. If we look at retail sales statistics, for instance, both globally and here as well as here in Australia, we see that retail sales has rebounded very strongly. If we look at July's retail sales data for Australia, for instance, it actually rebounded from about minus 15% to around 12%. So basically a very sharp, V-shaped rebound in terms of growth rates, reflecting that pent-up demand. But I think it's worth noting that so far the pickup in demand and the pent-up demand being reflected in the data, that's really centered around goods consumption, really around the purchase of durable goods, household goods, clothes, shoes, etc. While service consumption, on the other hand, is still around 50 to 60% below pre-COVID levels. So for those background knowledge, the retail sales data primarily covers more goods consumption and service consumption. But in today's terms, we know that service consumption accounts for about 60 to 70% of total consumption, compared to goods consumption, which accounts for the minority. So that's definitely a concern. But you may well argue, as you said, post the Spanish flu, there was a rebound, also not just in goods consumption, but also service consumption, especially with the rise in like fashion shows and film shows at the time. But I think, that was really because at that time, most people had already developed herd immunity to the virus, right? We know that over 1/3 of the global population back then was already infected with the virus. So I think people eventually were not worried about getting infected, because those, who would have got infected already got infected, or those who have died would have already died. And so people were just comfortable in going out and hanging out with friends again. But this time around, fast forward to today, we are clearly not there yet, right? We've only about 0.3% of the global population been infected so far. And so I think until an effective vaccine is actually developed, the fear will continue to prevent consumers from going crazy like they did back in the 20s. And even after the vaccine is developed, I worry that from an economist perspective, I worry that there could potentially be an inflection point where people get so used to this new ways of working and new ways of living that we see a permanent shift in behaviors, right? Like people choosing to invite friends over to watch Netflix more often than they go out for movies, or people choosing to drive around during holidays instead of taking an airplane, or even like this, right? We choosing to use video conferences, teleconferences, to communicate with clients instead of traveling, to another state or another country. And so, from that angle, we think that if that were to happen, some sectors, especially some service sectors, may never recover back to where they were pre-pandemic. And so, growth could potentially become permanently lower, as we saw during the GFC. And, one final point I would also add that differentiates today from the 1900s is that, back then, I think what really drove the Roaring 20s was a huge wave of technological innovation, like the development of cars, airplane, washing machine, fridge, etc., that really helped contribute to the increase in productivity growth as well as growth in general. But if you look today, I think those low hanging fruits for technological innovation, that's probably, we have probably less of those low hanging fruits today, right? You could argue that there could be more room for 5G networks to improve or Tesla cars to improve, but I think the slope for innovation is definitely much flatter today compared to where we were before. And so the incremental value add to productivity and growth will also be lower. And on top of that, we also saw business spending back then, basically increase significantly. But I think, just given how much uncertainty there is today, we think that the uncertainty will act like a tax that causes businesses to discount future returns more heavily, and thereby, making them less willing to invest and spend today. And, it's what we've seen, a structural trend happening post the GFC and not just, in the last couple of years.
That's a really interesting point you make about innovation and technology. Presumably, we're certainly at different starting points. If you speak to most folk today, they would say that we're living in the most technologically advanced and innovative era that we've ever lived, and that may very well be true for the era that we've lived in. But certainly, I think looking back in the rearview mirror, history can teach us a lot. Can we talk a little bit about the consequences? So you make reference to the working habits of people, and I think that's probably the biggest question that is being thrown around now and kicked around, which is what impact does or will COVID have on a new shift of working from home, new ways of working, less use of office space? What are these new patterns that may emerge out of COVID specifically to do with the way we work?
Yeah, sure. So I think, COVID as a whole, we'll see that it has accelerated a lot of the structural trends that were already in place before COVID, but it just simply served to, accelerate that shift towards, things like a move to a more virtual economy, automation, and things like US-China tensions, and even, things like income inequality, et cetera. But on that point, on the new ways of working point, I think the reason why, this comes up so frequently is because a lot of people are concerned of what that means ultimately for, say, things like commercial property, right? For office leases or retail leases, shopping malls, et cetera. And I would say, I think, as I said earlier, this is something that has been ongoing even before COVID, the move to a more, virtualized way of working as people start to innovate with new ways of, putting call centers at home so they don't have to actually rent the office space. But I would say this is probably more of a long-term, transition to that steady state instead of a, overnight thing where, after COVID, we'll see most offices being empty. I don't think that's going to be the case, given that most, offices are multi-year leases, and so it's probably very difficult to actually cancel the lease just based on this epidemic. And in fact, if you look at a lot of surveys taken by multinational companies, I read the survey the other day by Gartner, where they suggested that most multinationals are still planning to retain their office leases for the next 10, 20 years. And only about 20% of them suggested that they will move only around 10% of their workforce to work permanently from home or work permanently remotely. And so I think that's definitely the minority there. And even within the steady state, I don't think that there'll be a permanent, I guess, where everyone starts to work from home, because I think there's still value in just being with your colleagues and just turning around your chair and sharing ideas. What I mentioned earlier about the idea multipliers, we actually wrote a paper on that where we suggested that the next boost to productivity has to really come from this idea sharing, and one way to do that will be to be in the same physical space. So I don't think one, that the transition will be overnight, and two, I don't think that the steady state will see offices being empty significantly.
I think as human beings, as you know, Beatrice, we have a recency bias. So whatever has been happening recently, we just project that out into the future. And I think I agree with you as to how all of this plays out. Most people are generally wrong most of the time. So I think betting on that, having a contrarian stance on that, I think the odds are in your favour. What we might do, Beatrice, if that's okay, in light of all the things we've talked about, one of the things that Vanguard do, and I keep a real close eye on this, is looking at capital market expected returns over long periods of time. So we talk about the bond market, we talk about the stock market, etc. And certainly one of the things that Vanguard and we don't get involved in is trying to predict what markets are going to be doing over the next 3 months, 6 months, or 12 months. History does show us that setting expectations for longer periods of time, 7, 8, 9, 10, some argue 12 years, the confidence levels are much higher when you're looking that far out. Can you give us some insight into Vanguard's latest research when it comes to expected returns for capital markets domestically, globally, etc.?
Yeah, you're spot on. So, at Vanguard, we don't believe that anyone has a crystal ball. And so we place our conviction more on the longer term forecast for asset returns. So over the next 10 years, what we expect to get, on an annualized basis for equities as well as fixed income, as well as a balanced portfolio. And so, before we actually move into the return outlook, I think it's helpful to frame this discussion as to where valuations are at this point, because we know that, valuations over time are, one of the biggest drivers of returns. And I think at this stage, there is quite a lot of concern, especially among investors, whether the equity market is still an attractive asset class to invest in, given just how much, we've seen the rally actually go for and how strong and how quickly the recovery has been, right? And so there's some concern that, equity markets at this point are somewhat stretched or somewhat overvalued. But, if we look back at our fair value model for equity markets, we actually find that most equity markets at this stage are still fairly valued, although, within the fair value range, there are different degrees of fair value, right? With Australia, being at the, most valued or closer to the undervalued range, just given, that we haven't rebounded as quickly as, some other markets like the US and China. Whereas if you look at, say the S&P 500 as well as the CSI 300 for the Chinese equity market, they're still fairly valued, but they're definitely higher up in the range, just given, how much the market has rallied since April and since May. And I think, how quickly this rebound recovers also goes back to, the fact that China was first in and first out of the crisis. And so this explains why it has outperformed the rest of the world. And for the US is also because, it has potentially, higher weight in sectors such as technology and healthcare, which has benefited. I hate to use the word benefit in this kind of pandemic, but, nonetheless been more immune to the pandemic compared to other sectors, other more cyclical sectors like recreation and entertainment. So that's one. But broadly speaking, we still think that valuations as a whole in equity markets are still valued at this point in time. And so, what this means for equity markets in terms of the return outlook, we think that, the return outlook has modestly improved compared to December of last year, where, valuations were really, really stretched at that time. We think that because of the stretched valuations, our December forecast back then was around 4 to 6% on an annualized basis for equities, and slightly higher for global ex-Australian equities. But fast forward to today, we realized that the equity forecast has actually improved as a result of better valuations and the correction in valuations. And so we've upgraded our forecast from about 4 to 6 to now around 5.5 to 7.5%. But on the other hand, on the fixed income side, given how much yields have fallen today relative to history, we've actually downgraded our fixed income outlook slightly to around 0.5 to 1.5%. But nonetheless, I think, at this stage, and I'm sure, Rob, you do this with your clients as well, it's important to, stress the role of bonds in a portfolio. Is it there to enhance your return, or is it, there really to serve as a balance and a diversifier in your portfolio?
So it's safe to say, Beatrice, that investors can expect a lower return in the years ahead relative to what we may have been accustomed to following the GFC. The bonds...
Yeah, I mean, I think that's definitely true, that the efficient frontier, not just for equities, not just for bonds, but, across asset classes, the efficient frontier has, come down and also become flatter. And so that means that for every, unit of risk you're taking, you're getting less compensated in terms of returns. And so a lot of investors are saying, in this kind of low yield environment, shall we try something new? Shall we overweight high yield debt? Shall we overweight emerging market debt or financials to capture that higher dividend yield. Our simulations show that if you do that, you probably do get a slightly higher expected return down the road. But you know what? It also comes with much higher volatility, much higher risk, as you basically ignore that, a diversification among asset classes, and could also lead to an overtaking of risk exposures above and beyond your risk tolerance.
Yeah, and I think for that reason, it's really important to have portfolios designed for you and not for your next door neighbor. I don't think there is this perfect portfolio that, like the Ray Dalio all-weather portfolio. I think most folk would probably want something designed more specifically for them. Just before we wrap up, Beatrice, I'm curious to pick your brain on what you think is the biggest regret investors will have 3 years from today.
I would say the biggest regret is probably not in terms of not doing something, but in terms of doing something that they regret. Because I think, at this stage, I think it's, especially back in March or even April, I think there's, a behavioral tendency for a lot of investors, given how much market has crashed, to just sell out completely of equities and go straight into, safe haven or even things like gold. Just to preserve that cash, given that we all experienced that cash vacuum at that time. But we have seen that I guess the benefits of actually having that discipline, having that patience to stick through your plan and stick through your goals, instead of being driven and swayed by what happens in the markets. I think those investors actually stay the course and refocus back on the total return framework instead of just focusing on income per se. I think those investors will have the best chance of success going forward compared to someone that, basically just gets swayed by what happens in the market, such as now, going into US equities just because it's doing well, and, overweighting in Australian equities just because they feel more comfortable there. I think, that potentially result in an inefficient asset allocation over time if that was the case. Yeah.
I think if we all knew the answers, Beatrice, we wouldn't be here. It'd be really interesting to see how things play out. Certainly at the end of September, when government benefits start to shrink, the boost in savings that we're seeing in Australian bank accounts, a really fascinating thing to look at, and how much of that will be spent. Will we see a splurge when restrictions are lifted? Maybe not. How sustainable will they be? We've got elections in the US this year. There's talks of tax hikes depending on who takes office, which could potentially lead to cash flow problems for corporates who have recently geared up, who've got much higher debt levels. You talk about capital expenditure and capital investment from corporates. Whether that happens because of a flow-on effect and implications of this pandemic is obviously yet to be seen, but time will tell. Fascinating conversation, Beatrice. Thank you so much. On that note, thank you again for joining us. Have a great weekend, and we'll chat to you again soon.
Thank you. Bye.
Bye for now.